are more likely to be denied loans or receive less money than other borrowers. In fact, according to the Fed's Small Business Credit Survey, in 2023, only 32% of black small business owners with employees received the funding they applied for, compared to 54% of white small business owners. This is why SBA's lending programs are so critical. They fill gaps. They level the playing field. In particular, SBA's program, which is a subset of 7A, utilizes community-centered, nonprofit, and mission-based lenders. The program makes small dollar loans with a focus on reaching underserved small business owners. While the program does not define underserved by race or gender metrics, it reaches certain populations better than the traditional 7A program. For example, in fiscal year 2024, the Community Advantage Program made 53% of its loans to startups and 43% to entrepreneurs of color. The traditional 7A program, in comparison, made only 32% of its loans to both groups. SBA has a responsibility to address the inefficiencies in private lending to support true competition. It is the government's responsibility to make sure that there is capital for all entrepreneurs, regardless of their background. The Biden administration understood this. They doubled the amount of small dollar loans, maintained a healthy 7A loan program, and ensured a 99% repayment rate. A 99% repayment rate. My witness here today from Massachusetts, Ms. Guerrero, is a clear example of an entrepreneur who just wanted to serve her community, but struggled to get the funding to do so. She was unable to receive funding from her community bank, who is also an SBA lender, and she did not have generational wealth to rely upon. That's where Common Capital, a Massachusetts-based lender, and SBA's Community Advantage Program stepped in. So thank you, Ms. Guerrero, for taking the time to share your experience with the committee. Your story is just one example of why SBA programs like the Community Advantage Program is so important. And I look forward to hearing from our witnesses about their experiences with SBA's lending programs. And I also want to acknowledge the committee's efforts last Congress to codify the Community Advantage Program. And I'm hoping that we can work together, Madam Chair, on a bipartisan basis, not only to maintain the integrity of SBA's lending programs, but also to ensure that they serve small business owners from all backgrounds across our country. Thank you, Madam Chair.
Thank you very much, Ranking Member Markey. And now I want to extend a warm welcome to all of our witnesses. Thank you for joining us today. I want to introduce the two witnesses who are testifying today on behalf of the majority. I am thankful that these two accomplished community bankers made the trip to Washington, D.C. to share their expertise and insight into the SBA's 7A loan program with this committee. And so we'll start with my Iowan first. And thank you. It's Mr. Timothy Fitzgibbon, who is the Senior Vice President at First National Bank from West Des Moines, Iowa. Mr. Fitzgibbon started and built the SBA lending business at First National Bank, where he has worked since 2017. Previously, Mr. Fitzgibbon was the Senior Vice President at the National Council of Higher Education Resources for 12 years. And prior to that, he was the Director of the Guaranteed Student Loan Program at the Iowa College Student Aid Commission for more than 14 years. Mr. Fitzgibbon holds a bachelor's degree from the best university, Iowa State University. And next is Ms. Itzel Sims, and she is the Director of SBA Lending at First Security Bank, headquartered in Searcy, Arkansas. Ms. Sims has a 24-year background in SBA lending and previously worked at Simmons Bank and Regions Bank. Ms. Sims obtained a Bachelor of Business Administration from the University of Texas at Dallas. Thank you again, and I now recognize Ranking Member Markey to introduce his witnesses.
No, thank you, Madam Chair. I'm pleased to introduce our two witnesses who have a business relationship and it can explain how it works for all small businesses. And I would like to add, though, I'm kind of shocked that Mr. Fitzgibbon did not go to the finest Jesuits college in Iowa, Loris, okay? The Fitzgibbons, I think the Fitzgibbons somehow or other, I don't know how much they welcomed you home when you didn't go to the Jesuit school. So Mr. Raymond Lanza-Weil is the president of Common Capital, which is a nonprofit community development financial institution located in Springfield, Massachusetts. Common Capital provides SBA microloans and community advantage loans, as well as technical assistance to small businesses in Western Massachusetts. Mr. Lanza-Weil's work provides entrepreneurs from underserved communities with financing to start and grow their business ventures. His team works with borrowers in a holistic manner to ensure the success of these small businesses. Ms. Marina Guerrero is a mental health counselor and the owner and founder of Colorful Resilience, a business that provides a mental health services to all, but especially to people of color, the LGBTQ community, and immigrants. She has operated Colorful Resilience for 3 years, and as a result of her entrepreneurial spirit, the Community Advantage Loan, she now runs a thriving small business with 15 employees and has provided vital mental health services to over 3,000 clients. So it's a perfect example in Springfield of these two institutions being able to work together to make sure that we have a thriving small business. I thank you, Madam Chair, for welcoming these witnesses.
Yes, again, thank you to all of our witnesses for being here, and thank you, Ranking Member Markey. Briefly, I'd like to take a moment to explain our lighting system there in front of you, the little boxes. There are 3 lights in front of you. Green means go. Yellow means you're running out of time, and red means to go ahead and quickly wrap up your remarks. I ask unanimous consent that the witnesses' full statements be included in the record. Without objection, so ordered. As your written testimony has been made part of the record, the committee asks that you limit your oral remarks to 5 minutes. And with that, Mr. Fitzgibbon, you are recognized now for 5 minutes for your testimony.
Chair Ernst, Ranking Member Markey, and distinguished members of the committee, thank you for the opportunity to appear before you today to discuss managing risk in the SBA 7A loan program. My name is Tim Fitzgibbon. I'm a Senior Vice President with First National Bank, a $1.1 billion community bank based in Ames, Iowa, and founded in 1903. I am testifying today on behalf of the Iowa Bankers Association and First National Bank. My responsibilities include managing 2 specialty loan programs, SBA and student loan refinance, and I'm also a licensed investment advisor. I'm here today to share my viewpoint not just as an SBA lender, but also a 40-year participant in government-backed loan programs, including home mortgages and student loans, where I've spent a good part of my career helping borrowers manage their debt, improve their credit, and avoid default. Risk in any loan program is primarily managed through sound underwriting policies. Prudent underwriting ensures equitable treatment for all applicants and is intended to be a good predictor of a borrower's future success. In short, good underwriting protects the consumer along with the lender, and in the case of the government-backed SBA program, the taxpayer as well. In 2023, new rules were written for the SBA program with the admirable goals of streamlining the application process and increasing access to funding for small business owners, particularly those in underserved communities. Major underwriting changes included removing the applicant's personal financial resources from the credit elsewhere test, waiving equity injections, reducing insurance requirements, and permitting lenders to, quote-unquote, do as you do in underwriting SBA loans. Reducing underwriting criteria to increase loan access is not a new idea in federally backed loan programs, but it has not always proved wise. A similar approach was used in the 1990s to increase homeownership through lowered credit standards for private market and FHA loans, which contributed significantly to the subprime mortgage crisis of 2008. A more recent example continues today with the Federal Parent Plus student loan program. Already low underwriting standards were further diluted in the early 2010s to allow more families to access the Parent Plus program, which has resulted in countless older Americans becoming buried in debt they cannot afford. Originating government-backed loans for borrowers who can never repay them is predatory in nature. It is imperative that the SBA closely monitor the impact of its reduced underwriting standards on the borrowers it serves. To that end, early indicators suggest that there are already signs of credit stress for SBA loans made under the new rules. For example, according to a recent risk assessment by the SBA, I quote, "The Small Business Administration's flagship 7A program lost hundreds of millions of dollars in 2024 as agency fee reductions combined with an increase in loan defaults to result in negative cash flow." Similar analysis done by third-party service providers show loans made under the new rules are defaulting at a much faster and higher rate than loans made in other years, particularly those originated by non-bank lenders. I'd like to end my statement with a cautionary observation based on testimony provided just last year by Administrator Guzman in hearings before this committee, where she suggested the SBA should restart its direct government lending program. I urge committee members to study the current condition of the federal direct student loan program before considering such a move. History has shown that direct government lending can lead to expensive loan modifications and even debt forgiveness to mask non-performing loans. Loan forgiveness does not manage debt, it simply passes the cost on to the taxpayer. Iowa banks are committed to providing access to SBA financing to our small business communities. While we applaud efforts to streamline SBA loan processing and expand in a safe and sensible manner the number of small businesses the SBA program can assist, we urge Congress and the Small Business Administration to restore prudent underwriting standards and ensure proper oversight for all of its lending partners. I look forward to your questions, and I thank you again for the honor of participating in this hearing. And Senator Markey, I'm proud to tell you that my daughter's a Loras grad.
Thank you, Mr. Fitzgibbon. Now we will recognize Mr. Lanza-Weil, and you are recognized, sir, for 5 minutes of your testimony.
Thank you, and good afternoon, Chair Ernst, Ranking Member Markey, and distinguished members of the committee. I appreciate the opportunity to speak with you today. I am Raymond Lanza-Weil, a recovering banker and president of Common Capital, a 35-year-old nonprofit CDFI loan fund based in Springfield, Massachusetts. Common Capital makes loans to small businesses that can't get the financing they need from conventional lenders, such as banks and credit unions. We make loans up to $300,000, and we provide no-cost business education and training to our borrowers. Our business assistance program is primarily funded by annual grants from the SBA's microloan program. Common Capital serves a 4-county region with 820,000 residents. Our annual operating budget is just shy of $2 million. Even though we're a small organization serving only a fraction of the state's geography and population, Common Capital is the leading SBA microlender and SBA Community Advantage lender in the Commonwealth of Massachusetts. Since our founding in 1990, we've made over 900 loans totaling more than $35 million to small businesses in Western Massachusetts, all sorts of loans, not just SBA loans that have helped create or retain 2,200 jobs. At the end of 2024, Common Capital's loan portfolio totaled $9.4 million, a little smaller than First National Bank's. 54% of our loans receivable were SBA microloans or Community Advantage loans, and by itself, the CA loans, the Community Advantage loans, make up 34% of our portfolio. Common Capital's lending is high impact, and that includes our CA loans. 87% of our CA portfolio dollars is loaned to businesses owned by people with low to moderate income or located in LMI census tracts. 73% is loaned to startup businesses, 47% to women-owned businesses, and 17% to veteran-owned businesses. Common Capital was one of the original Community Advantage lenders. Since making our first CA loan in 2012, we've made 41 CA loans totaling $5.3 million with only one loss. The Community Advantage Program helps us fulfill our mission of creating economic opportunities for people with low to moderate income by increasing access to capital for the small businesses they own. For example, here's a story about one of our CA loans. Alan had worked in construction in rural western Massachusetts for over 35 years when, in 2018, he had an entrepreneurial seizure and decided to open his own timber frame construction business. After 3 successful years, significant supply chain issues and higher prices on construction materials resulted in losses on a large fixed-price contract. But demand for Alan's craftsmanship continued to grow, so the business sought financing for new equipment and working capital from their bank, which was unable to help them due to their recent losses. Alan turned to Common Capital. The path to yes was challenging because the business's assets available as collateral were well short of our underwriting requirements. Common Capital was able to offset this shortfall with an 85% community advantage guarantee, and today this rural business has retained its 6 employees, hired new ones, and is thriving. As you know, as this story illustrates, regulated financial institutions can't help every business that applies for a loan, and nor should they. Banks necessarily say no to some applicants in order to protect their depositors and shareholders and to contribute to the safety and soundness of our financial system. Yet banks and credit unions are our primary source of referrals. We don't compete with banks. We support and augment their customer relationships. Referring banks keep their customers as depositors and continue to provide other banking services to these businesses. When we provide a loan to a bank's customer, it's a win-win-win. Before I conclude, I want to tell you another story. Celeste and Jessica had a combined 30 years of experience working as nurses in and around Springfield when, in 2021, they recognized the growing need for home health care in their urban communities. They responded by starting their own home health care agency. Celeste and Jessica could not obtain financing from a bank due to being a startup and a lack of sufficient collateral. Once again, Common Capital turned to the SBA's Community Advantage Program to overcome these challenges and help 2 entrepreneurs start a business that is providing essential health care services and creating jobs. Senators, as I wrap up, I want to tell you that too many small businesses and business owners hear no from a bank successfully search online for easy money. It's available, it's expensive, and it's harmful to our business community. To combat this, CDFIs like Common Capital and other community loan funds try to fill the gap. With our help, these small unbankable businesses are creating jobs, generating economic activity, and paying taxes. These small businesses continue to be bank customers, and if they do well enough, they'll become bank borrowers as well. We accomplish this work with the support of the SBA. Our continued success and the success of the small business community in Western Massachusetts depends upon the availability of SBA microloans and the CA program. I urge you to continue supporting the Community Advantage Program, to expand it so that more mission-focused lenders like Common Capital can increase access to capital for low to moderate income and low-wealth entrepreneurs. Thank you.
Thank you, Mr. Lanza-Weil. And we will move next to Ms. Sims, and you are now recognized for 5 minutes of testimony.
Chair Ernst, Ranking Member Markey, and members of the committee, thank you for the opportunity to testify at today's hearing. My name is Itzel Sims, and I am the Director of SBA Lending for First Security Bank, which is headquartered in Searcy, Arkansas. I'm testifying today on behalf of American Bankers Association, Arkansas Bankers Association, and First Security Bank. Small businesses are the backbone of American economy. The SBA 7A program helps small businesses that might not otherwise have access to capital and obtain loans so they can grow and create jobs. In my 26th year of making loans to small businesses, I'm very proud of the work we do at First Security Bank to assist businesses across Arkansas with 7A and other small business loans. First Security is a privately held community bank with a $1.5 billion in total capital, $8.13 billion in assets, and 1,000 employees throughout Arkansas. After holding several SBA lending positions, I joined First Security Bank and started an SBA lending platform for 7A, 504, and Express loans. First Security is right now topped at a top 10 SBA lender in Arkansas. This is in a very important time for 7A program. 2 years ago, SBA lifted the moratorium on the number of non-bank lenders that could participate in the 7A program, while simultaneously loosening underwriting standards for these loans. It has experienced increased defaults since those changes, particularly in loans originated by non-bank lenders. This committee can play an important role in strengthening the program so that all lenders make 7A loans in a safe and sound manner that helps small business gain access to capital. Here are recommendations for improving the program. In 2023, SBA lifted the moratorium on the number of non-banks that can participate in the 7A program, granting six new non-banks to participate in the program. At the same time, the agency also loosened underwriting standards for loans of $500,000 or less. This has contributed to rise in default rates. Data compiled by Lumos Technologies show that 7A loans originated by non-bank lenders in 2023 had a default rate of 8.1% in 2024, which is more than double the default rate of 7A loans originated by banks in 2023. SBA should return to the more robust criteria for underwriting 7A loans that had been in place prior to 2023. Moreover, the agency focused on increasing the number of banks that participate in the 7A program instead of new non-bank entrants. SBA should also reinstate the loan authorization as a required document for 7A loans. It should also reinstate the requirement that 7A small business owners provide a 10% equity injection when a borrower is a startup or when the borrower is purchasing an existing business. To increase efficiency, SBA should reinstate the franchise directory, a valuable resource that assisted lenders with determining the eligibility of a franchise for a 7A loan before it was discontinued in 2023. Although the focus today is on strengthening the 7A program, the small business lending landscape continues to be threatened by the CFPB's implementation of Section 1071 of Dodd-Frank. Section 1071 requires financial institutions to collect and report detailed data on each application for small business credit, including the race, sex, and ethnicity of the business owners. CFPB's rule expanded the 13 data points required by Congress to 81 data points for each applicant for credit. This will significantly increase the cost of credit, decrease the availability of credit, and make it harder for us to serve small business customers. Congress should repeal Section 1071. In conclusion, we strongly support the committee's goal of strengthening the 7A program and facilitating small business lending more broadly. We urge Congress to ensure that the SBA reinstates previous underwriting standards on 7A loans, not grant additional non-bank licenses without a demonstrated need and proof that the agency can effectively supervise new entrants, take the actions to improve the efficiency of the 7A program provided in our testimony, and repeal Section 1071 of Dodd-Frank. This would help strengthen small business lending and enhance the ability of banks to make critical loans that drive economic growth in our nation's communities. I really appreciate the opportunity to testify, and I look forward to your questions.
Thank you very much, Ms. Sims. And now, Ms. Guerrero, you are recognized for 5 minutes.
Thank you. My name is Mayrena Guerrero. I'm a licensed mental health counselor and entrepreneur in Massachusetts. I am honored to be here and talk about my experience with the SBA Community Advantage Loan through Common Capital. My business is Colorful Resilience, a mental health clinic that provides outpatient mental health services to Black, Indigenous people of color, lesbian, gay, bi, trans, queer, and others with various sexual and gender identities, immigrants, first-generation people, and our allies. What sets us apart is that our team members represent the communities we work with. These brings about cultural competency that comes not just from education, but shared lived experiences with our clients. I hold a Bachelor of Science degree from Universidad Católica Santo Domingo in Dominican Republic and a Master of Science in Mental Health Counseling from Fitchburg State University in Massachusetts. Go Falcons. After graduate school, I worked in community mental health for 3 years, providing outpatient services. After completing the necessary hours and passing the licensing exam, I obtained my license to practice mental health counseling independently in Massachusetts. In 2016, I established a private practice, marking the beginning of my entrepreneurial journey as a solo practitioner. My practice filled up quickly as clients discovered me through the psychologytoday.com providers directory. In my published profile, I discuss my therapeutic approach and comfort in working with immigrants, people of color, and members of the LGBTQ+ community like myself. I quickly noticed clients sought me out primarily because of our shared identities. In 2020, due to the mental health crisis resulting from the pandemic and the Black Lives Matter movement, inquiries for services increased from 2 a day to 20. My practice was packed, and I wondered where to refer individuals seeking support based on identity affinity. I realized then that there was a niche in the market that was not being addressed, and that is when the idea for Colorful Resilience was born. If I were going to do this, it would be done right. My company will have multiple practitioners and be the work environment I always dreamed of. The humanity of the clinician will be front and center because happy and healthy clinicians produce better therapeutic outcomes. I would do things differently and go against the industry standard. My clinicians would receive a guaranteed bi-monthly paycheck with a salary that exceeds the living wage for our county based on the MIT living wage calculator. A yearly inflation raise would be essential to prevent a pay cut, and an annual productivity raise would incentivize meeting productivity goals. Both part-time and full-time employees will have access to health and dental care. Additionally, the company will reimburse continuing education credits as 15 CEs are required annually to maintain our licenses. And now we're in year 3, and this year we're able to offer 401k to our employees. Burnout is a significant issue in the mental health field, leading to frequent turnover and a mass exodus from the profession. I recognize that establishing reasonable and sustainable productivity expectations is crucial. Furthermore, supporting and encouraging clinicians to attain their private practices is essential for maximizing their earnings and increasing representation from these communities in the field. In other words, my team members were not leaving Colorful Resilience because we were a lousy employer, but because they were ready to self-actualize professionally. So the idea was there, and it was a good one. But I needed capital, so I went to talk to my community bank of 15 years. I sat down with a person from commercial lending, business plan in hand. He listened to me and told me it was an excellent idea, but that they didn't fund startups. For them to lend me the $300K I needed to start my business, I would need to have assets that amounted to that much, which I didn't. It was the bank who told me about Common Capital. I went to Common Capital's website and filled out a simple form. Then, with a business plan in hand, I met with them. They supported my idea and told me they would work with me to secure the funds I needed to make it a reality. Common Capital helped me secure an SBA Community Advantage loan for $250,000 and a $50,000 microloan at a 6-year term and a 7.5 interest rate. In addition to the loans, Common Capital helped us get marketing and technical assistance help from a third party, contributing to our recruitment efforts. From the very beginning, Colorful Resilience has submitted monthly profit and loss and balance sheet reports to Common Capital, helping keep us accountable as we go. Common Capital invested in Colorful Resilience, and we continue to experience their support to this day. On February 23, 2022, Colorful Resilience LLC became a registered business entity, and in August of that year, we started seeing clients. Today, according to the Boston Business Journal, Colorful Resilience is the 27th largest LGBT-owned business in the state of Massachusetts. We're a profitable company, currently employing 15 people and on track to hire 3 more full-time clinicians this year. We have about 550 active clients, and 3,000 people have had access to care because we exist. Outpatient mental health is primary care. Clients who are adequately supported and at outpatient mental health level rarely need to access higher, more expensive levels of care, like partial hospitalization, inpatient, or like a residential program. We keep the cost of mental health care down. We don't depend on government grants to function, and we pay taxes. Businesses like Colorful Resilience keep the American economy going in the right direction. The SBA Community Advantage Loan changed my life and the lives of many others. I am grateful that this program exists and was lucky to have access to it. Please continue to support organizations like Common Capital so that they can make businesses like mine possible. Thank you.
Thank you, Ms. Guerrero, and thank you for your work in brain health. We really do appreciate that as well. So now we will move on to the question and answer portion of the hearing, and I will recognize myself for 5 minutes for questions, and I will start with Mr. Fitzgibbon. So, Mr. Fitzgibbon, as you know, the Biden administration significantly weakened underwriting standards in the SBA's 7A loan program. Since those changes were implemented, the 12-month default rate has more than doubled, and the early default rate has almost tripled. How important are strong underwriting standards to the long-term stability of the 7A loan program?
Thank you, Senator. I think prudent underwriting provides the foundation for long-term stability. There are other factors like guarantee fees and so on, but they're not as important as underwriting. It's truly the cornerstone of managing debt.
No, that's good. And Ms. Sims, to you, thank you for being here today. The previous administration allowed additional non-banks, including fintech firms, to participate in the 7A loan program. So as a community banker, how do your underwriting processes differ from those that are non-bank lenders, such as fintech firms, and how do these differences affect the loan performance in the 7A loan program? Can you hit your button? Yeah, thank you.
Sorry, I forgot to push the red. Community bankers, we live and we dine and we use the services that business owners have. So we see people, when we provide loans, we're not just providing loans to paper, we're providing loans to people. So we try to find financial solutions and complement our banking needs through our SBA programs, depending on how much assets they have, how much capital they need. And so having that availability through the SBA program is imperative for us. The credit underwriting is the same for SBA lending. We still have to make sure that the loan can be repaid back. But a lot of times our entrepreneurs need education. They need to know how much debt they need to have. They need to have a budget. I like to say the saying, if you don't plan, you plan to fail. Mm-hmm. And a lot of times these business owners need guidance from us as a community banker to be able to either say, hey, you need to start with us, or they may need to start with a community advantage lender just to get started. So just being there to educate the client makes us very different than fintech, which is where my concern is. Fintech is more about a predatory approach and trying to just give money as fast as they can, and they don't really see them as human. They just see them as another source of financing and getting rates. So that's where my concern is the most, is the fact that they're taking the human approach away from community banking when you allow fintech to take over.
Yeah, I do appreciate that support. Thank you. And Mr. Fitzgibbon, the SBA has had 4 straight quarters of negative cash flow. Over roughly that same period, upfront borrower fee revenue has decreased by 13%, while loan purchases, which occur when SBA has to buy a defaulted loan from a lender, have increased by 73%. How concerning are these trends, and what steps need to be taken to ensure that the 7A program continues to operate at zero subsidy from the taxpayer?
Well, thank you, Senator. I think 4 quarters of data is, you can't draw every conclusion from 4 quarters of data, but it's all we have. And it is alarming for in comparison to the other vintages. So I think looking at borrower fees is probably, and lender fees, and reintroducing them is probably necessary. I would say that the cost of inaction is high, because regardless of the cost of the taxpayer, every loan that shouldn't have been made that defaults ruins the financial life of that small business owner. And so you could take a wait-and-see approach for the year and see if things normalize, but I think there's a human cost to that to me seems unadvisable.
Okay, thank you. And Now I would like to ask a question to all the lenders on the panel. Over the last 5 years, we have seen a dramatic expansion in the use of lender service providers, or LSPs, by SBA lenders. These LSPs assist SBA lenders by referring, processing, and servicing loans and are often increasing the volume of SBA lending. Does your company utilize an LSP? And could you just talk about the proper role of an LSP in assisting SBA lenders? And Mr. Lanza-Weil, I'll start with you first, and then we'll go to the
That's
other
easy.
lenders.
No, we don't.
Okay, thank you. Mr. Fitzgibbon.
We don't use them. I think they play a helpful role if the lender that they're partnering with has good guardrails. But I think in combined with a fintech lender that it's all about churning volume, I think that they can be a part of the problem.
Okay, thank you. Ms. Sims?
Starting an SBA department in a community bank is daunting. It's a difficult task. And so it can be very alluring to look at an LSP. I looked at it at one time when I was starting the department, but it's really difficult to keep consistency of your culture, of who you are as a bank when you outsource it to somebody else. Keeping that consistency and also keeping the culture of your bank is out of your control. And a lot of times, the customer experiences very bad customer service because they're not only dealing with us, they're also dealing with the LSP. If it's sold in the secondary market, they're not able to renegotiate their interest rate. So they're also put some guardrails on that. So LSPs do have a sense of purpose, don't misunderstand me, but they can also abuse that situation. So we do have to enter that cautiously when using LSPs.
Okay, thank
And
you.
we do
That's
not-
very helpful.
We do not use LSPs, by the way.
Okay, thank you very much. I appreciate that. I will turn it now to Ranking Member Markey for your questions. Thank you.
Thank you so much. And so great news, really, really, really great news. In the United States, last year of the Biden administration, 886,000 jobs directly related to 7A, either created or retained. Great number. Another great number. In Donald Trump's last year before COVID, 2019, the default rate on 7A program, 2.75%. Last year, the last year of the Biden administration, 2.76% default rate. Now, we do admit that the default rate did go down to 1.32% at the height of COVID, but that was because of this great committee's work, passing the PPP program, passing the EIDL program. We were actually able to lower the default rate because of our actions to help those small businesses. But it's returned to normal. Trump, 2.75%, Biden, 2.76%. So we'll give Trump the win there by one-tenth of 1%. Okay, he wins in that one category, but let's just say we're back to normal in terms of the 7A program, and we should be very, very proud of the work that all these business people are doing out there. This SBA Community Advantage Program has demonstrated success in making small dollar loans to small business owners that struggle. We see this story here in Springfield, Massachusetts. We see the lender and the recipient creating some capitalist magic that otherwise would not exist. And these lenders don't just provide loans, they provide financial help, marketing help, technical assistance that otherwise Ms. Guerrero and people like her all across the country, creating 886,000 jobs, would not otherwise have, which is kind of this brilliant construct that we have. So, Mr. Lanza-Weil, you say in your testimony, we lend to people, not to paper. Can you explain how Common Capital's approach to making a loan to small business contrasts with a conventional lender?
Absolutely. We're a high-touch lender. It's all about building a relationship with a borrower, with an applicant. You know, my first day on the job as a bank trainee in 1986, an old-time lender who smelled like cigar smoke pulled me aside and said, "You got to know this, know your borrower. It's the first rule of lending." And I think sometimes in larger institutions, and certainly in fintechs, which I'm not here to bash, we lose sight of that. I think Ms. Sims referenced it as well. Building a relationship with an applicant, getting to know that person as a human being, getting to know them as something beyond the paper on which their credit report is printed is so important, and we invest a lot of time. It's inefficient, it's slow, it's high touch, and it's highly effective.
No, I agree with you. When I needed student loans, I was sitting next to my mother and father at the First National Bank of Malden, and Mr. Wentworth, the banker, he said, "Mr. and Mrs. Markey, you paid every month on the mortgage, so we trust you, so we'll give the loan to
There you
Ed."
go.
Right? High touch, right?
Exactly.
They knew the customer. So, Ms. Guerrero, talk about how Mr. Lanza-Weil and his operation was able to help you.
Gladly. Common Capital has been just super helpful. The truth is that I really don't know how we would exist as a business if Common Capital and the SBA Community Advantage Loan Program was not available to us. I like the fact that the support that we receive from them. I mean, you told me earlier there were 9 people in your team. I really don't know the 9 of them, but I know 6 of them by name. And I know how to get a hold of them for questions or anything like that. And that is just a relationship that I don't have with my community bank.
Yeah, and so give us one quick example, if you can, of something that they could help you to do that you would have had no capacity as a startup small business.
I mean, exist. Sincerely, Senator, like, who would have given me okay, my other option to get the money to start my business would have been a predatory lender that would have given me a really high interest rate and terms that were really not conducive to profitability. So it's as simple as that.
And you could have found them in Springfield, Massachusetts.
Oh, of
the
course.
predatory lenders.
You can find them anywhere.
Huh?
You can find them anywhere.
Oh yeah. So you're just a perfect example of a wonderful system creating 886,000 jobs that is working with a default rate equal to the Trump years, okay, which is just an incredible achievement. So it really helps to show how America can be great in helping startups to get over that financial hump. Thank you.
Yeah, thank you, Ranking Member. And I do want to stress it's the early defaults are really the issue that we're getting at today. The last 3 years, loan defaults are rising faster than pre-COVID levels, and the program is losing money for the first time in a dozen years. So it is something that we do need to scrutinize, and we need to understand why this is occurring. So we will go next to Senator Husted. You are recognized for 5 minutes of questions.
Thank you very much. Welcome to all of you. Thanks for being here today. I have a background overseeing a small business development center. I have a background on a board of a community bank where I was on the loan committee, and I know how much our regulators scrutinize what loans we do make and what loans we don't make. And that this is the community banks around the country are very close to their customers, and they know these issues quite well. And but what I don't know well is I've only been a senator for 4 weeks, so I'm trying to catch up on all the things that have happened in the past. And I know Mr. Fitzgibbon and Ms. Sims, you talked about rule and fee changes that had happened under the Biden administration, and I want to understand that better, and how that impacted the 7A program, and just what the exposure and the risk of that. So you just help educate me a little bit more about what that means, what the impact is. Mr. Fitzgibbon, I'll start with you.
Yeah, thank you, Senator. So, yeah, briefly, the rule changes reduce the underwriting criteria. And over the last couple of years, the guarantee fee and the lender fee was waived up to, I believe it's $1 million. No guarantee fee to the borrower up to $1 million. This year, it's no lender fee up to $500,000. So those are fees that support the program. In a sense, it's skin in the game for the borrower. Those have been waived for a couple of years. The concern is that the lessened underwriting criteria has allowed has resulted in loans being made that shouldn't have been made, and that's what's driving up delinquency and default rates.
Okay. And Ms. Sims?
So when you get insurance, you have to pay a premium to have insurance. So you think of the government guarantee in that sense, is that typically when you're asking for a government guarantee, it's protection on the loan for the bank. And so I've been an SBA lender for my entire career, and I've seen the fees my entire life where, SBA has provided this guarantee, this insurance to the lender, aka the customer gets this insurance as well. There's protection on their side, so there's benefit for the customer on that side. But typically, because we don't want this to be a burden on taxpayers, they self-fund through these fees. And so that's, really important to understand that we don't want the fees to be inappropriate, but we also want to make sure that they're not creating taxpayer money or impacting the taxpayer money.
So, summary, you think that would improve default rates and it would help sustain the program so that it's not
Sustainability is
taxpayers.
the key, right?
Yeah.
We want to make sure it can be in the black. We don't want it to be in the red. So if we see that there's problems there, we got to reevaluate the situation. When it comes to the underwriting, that's something else that I've never seen the what we call the SOP dramatically change to do what you do. That's the rule, and makes it very complicated to know, because I, as a community bank, can operate differently than another community bank. And having the regulations so loose, if you do what you do, also doesn't provide what I call a level playing field. And so that's important to also understand, is that the SOP has changed, and now if you feel comfortable providing loans that are, what I would say not prudent, then you're allowed to do that, because you are not regulated in the same way as maybe a community bank that has higher regulations.
Great. Mr. Lanza-Weil, do you have a thought on that?
Thank you, Senator. I don't know much about the fees.
Yeah.
What I do know is about underwriting standards. We're required to maintain our underwriting standards, even when the rules change in the SOP, the standard operating procedures. I think what we're hearing is that there are some lenders that haven't followed their own prudent underwriting guidelines, and that's perhaps not the fault of the program, that's the fault of the lender. So I'd be cautious about throwing the baby out with the bathwater. Our default rate hasn't changed. Among all the CDFIs I know, the default rate hasn't changed, because we're very focused on making good loans in our market. It sounds as if there's a lot of lenders out there that aren't doing that, and they should have more guidance and be more careful, and I would hate for their imprudent lending to harm our prudent lending.
Okay. Thank you.
Yes, thank you, Senator. Senator Rosen.
Thank you, Chair Ernst, Ranking Member Markey, and thank you all for being here and just spending, well, of course, your life working with small businesses, and for your work really in the mental health space. It's so needed. And I'm going to give a little bit of a plug here for Nevada's credit union and community banks. I know them all so well, and I will say during the COVID crisis, but all the time, like you said, they're in the neighborhood. These are their friends, their neighbors. They know people, they have a relationship with them. They know if maybe a family emergency happened and they can't pay something now and they'll pay it later, and they really want to see communities thrive. So I'm just know the importance of this kind of lending, and that special touch that you can give. It's very meaningful. And so I think we can all agree that the 7A program, it's a vital source of funding for our small businesses. And Nevada business have received over 700 loans totaling $355 million just last year alone. 99% of businesses in Nevada are small businesses, by the way. Although we're known for those big casinos, 99% are the small businesses. But it should be a shared bipartisan priority for the program, like you say, to run as efficiently as possible. And I'm really thankful for your testimony so far. But it's not surprising that loan defaults, delinquencies, they're more likely in times of economic uncertainty. And small businesses may face declines in sales or subsequent cash flows. Mental health, of course, I think you're going to stay pretty steady there. But similarly, poor economic conditions can put a strain on lenders who may be tightening their criteria and they reduce their loan volume. And so we might look at looming tariffs, unreliable federal funding, economic uncertainty. It's critical we understand, again, the impact it's going to have on all of you. So, Mr. Lanza-Weil, can you discuss how the broader economic picture in this country is going to, in fact, affect maybe the borrower's loan performance and your lending activity?
Thank you, Senator. I think you said the word already. It's uncertainty. The uncertainty that's existing in the marketplace today because of so much rapid and chaotic change is making it hard for us to plan. I don't know what the SBA's budget will look like next year. None of us do, obviously. I hope it's robust. But as we begin planning for our next fiscal year, we don't know how much money we can count on for an SBA grant that supports the business assistance that is so critical to supporting entrepreneurs like Mayrina. The business education and training that we provide is focused on helping people create and understand and use their financial statements and the management of their business. Mayrina knows how to be an exquisite mental health counselor, but probably didn't know much about QuickBooks before she came to us, or how to market her business.
Hopefully she learned pretty quickly, and then that's what we're going to ask, how the business environment impacting you and the uncertainty impacting you. You're working together, giving her the training, the resources, understanding how to be successful. How are you feeling in this moment?
Well, it is true that the need for mental health services is there, but it's also true that the economic landscape is making, for example, I'm noticing that my clients, instead of booking weekly, they're booking biweekly because they can't afford the copay or they have a hard time affording the deductible, or like people are losing their jobs, which means that they're losing access to health care, or there could be like an executive order, freezing government funds, which affects Medicaid and Medicare, and that's 20% of my income. So definitely there's an impact in my business.
Well, I want to go back to something you just mentioned, the importance of the SBA resource partners. As we see, it makes you successful. You're a great counselor, but maybe you didn't know QuickBooks when you started. And so we have to bring that critical support and the training for our small business owners, from Veterans Business Outreach Centers, Small Business Development Center, Women Business Centers, and the like. I was so proud to bring the first ever Veterans Business Outreach Center to Nevada. We have almost 250,000 veterans in Nevada, very entrepreneurial. And really, you provide that tailored support, that free counseling, that technical assistance so that they can do what they do. And I know I have a short time left. Can you talk, Mr. Lanza-Weil, about the importance of this financial management counseling? I know all of you could really speak to this, but that's a big part of what you're helping a small business owner do, and how critical it is that we keep these resources flowing for their success and payback of the loans.
Many of our applicants and borrowers have received services from our local Small Business Development Center network and from our Women's Business Resource Center, which is the Center for Women in Enterprise, which serves all of New England and has had to lay off some staff already because they are not getting the federal funds they need on an ongoing basis to pay their staff to provide services to small businesses. The way we mitigate risk in a community development financial institution is with hands-on business assistance and training. By making Mayrina a better business person, she's also a better mental health counselor and a more sustainable and viable business in the long term. And at this particularly uncertain time, if the economy worsens, banks will tighten their lending as they always do, and CDFI loan funds, which are countercyclical, will see an increase in demand. And that increase in demand means that we'll need more help from our service partners to serve the businesses that we're able to make loans to.
Well, thank you. I do believe small businesses, they're the engine of our economy, every state. Thank you for having this hearing, Madam Chair, and we need to continue to invest in the good work that you're doing. Thank you.
Great. Thank you, Senator Rosen. Senator Booker, you are recognized.
Thank you so much. I was excited to get on this committee when I got here because I spent so much time as a mayor trying to get more access to capital for businesses in the city of Newark, and we were able to see an explosion during a recession of new investment into our city, entrepreneurs succeeding. It was one of the best experiences. I got on this committee, and it's been one of the better bipartisan committees that I've had here, and just finding ways, because all of us know in our states there's so much investment-worthy people. I remember the now Secretary of State and I working together in the midst of the pandemic when the PPP loans were coming out, but we found an arbitrary rule that just barred people who had been justice involved, returning offenders. They'd had to be out of for 5 years before they could qualify for a PPP loan. That was arbitrary and just dumb, and my Republican colleagues agreed, and we got it fixed under the Trump administration. So it's just a great environment for us to continue to try to do good work. I'm a big person who believes in entrepreneurialism and the power for communities of capitalism, the double, triple, quadruple bottom lines that we find. And so I just want to jump into some areas really quickly. One concern I have, having had so much experience with micro loan programs inspired by the Grameen Bank in my community, I'm really worried that we've had 15 years of mission-based lenders through the Community Advantage program that have worked closely with small businesses to help them get the capital they need, which is often small. But in January, the SBA announced it would increase the loan maximum up to $500,000, which I think is going to have a really stunning impact. And right now, I'm hearing from lenders that they haven't had communication really from the SBA on whether they can offer increased loans to small business owners. There's a lot of delay going on. I got an extraordinary note from a small business owner in New Jersey that said, quote, a lender in New Jersey, excuse me, last week we had to decline a loan request from a farmer in Mulcha Hill who sought to expand his seasonal open-air farm into a larger year-round operation. The business was doing well despite its seasonal limitations. His goal was to provide his community with high-quality produce plants and specialty groceries year-round instead of in his current just 5-month operation. However, during our review, we determined that he required more than $350,000 to complete renovations, purchase equipment, and secure the necessary working capital for successful expansion. He was concerned about the risk of undercapitalization. We had to decline the request. Given his limited collateral, securing traditional bank financing would have likely been a challenge for him. We believe the borrower needed Community Advantage 7A loans of at least $450,000. So it's disappointing that small businesses in Jersey are missing out on opportunities with these larger loan possibilities. And so I'm hoping you can shed some light on this, Mr. Lanza-Weil. Have you been able to offer increased loan amounts in addition to the small ones that you're probably very familiar with? What would the impact be for your business folks?
For a long time, Senator, our loan limit has been only $300,000. So there's not been an effect in the past for the changes in the loan limits. But we'd like to raise our loan limit. We've internally for all sorts of loans, and we find that most of our larger loans, and a larger loan for us is a loan over $75,000, are people coming to us with insufficient collateral. So if we're going to raise our loan limit, we need an increased loan limit on the Community Advantage program in order to be able to continue to help low asset and low wealth individuals.
So I just think there's a lot of common sense fixes. I have some other questions I'm going to ask for the record that I don't think we'll be able to get through, and the chairwoman is just rough on me. She particularly picks on New Jersey. I'm going to ask some questions for the record. I hope that you all will respond. I want to thank the four of you because I know your heart and your determination. You do this work really to see communities flourish, and it means a lot to me that you would come down here and testify before the United States Senate. I know time is money, as you all know that, so it means a lot to me that you're here. But I hope you'll be, as the hearing is open, I hope that you'll be responsive to some of the other questions I have that I think can really inform this committee, which I hope continues its record of just working in a bipartisan manner to help folk out. So thank you.
Yeah, thank you, Senator Booker. My ears perked up when you said farmer.
I know. Good.
Yeah, I was so
it's
invested
my fourth
in
largest
that story.
industry. People don't think it is the garden state, you know.
In New Jersey, folks.
Did
I
you
love
say
it.
farmer? Farmer.
No, thank you, Senator Booker. Now we will recognize Senator Hirono for 5 minutes. Thank you.
Thank you, Madam Chair. I just happened to have met with some farmers from Hawaii. They have unique challenges because we are in the middle of the Pacific, and there are all kinds of invasive species, and including axis deer, and, people don't know that we have, mouflon sheep and others. But be that as it may, I think in you, Madam Chair, we have somebody who supports the support that we can give from SBA, particularly to entities such as farmers and the people who in rural areas. For Mr. Lanza-Weil, I just heard you say that you would want the loan limits to be raised. What is the loan limit that you are working with right now?
I believe it's $350,000, I believe.
And you would like that raised to what? And it requires the Congress to raise that limit?
I don't know who requires to raise that limit, but
Okay.
500 would be helpful to us. 500,000, that is.
And is that because, based on your own experience, that the amount of the kind of loans that people request are more in the 500 range as opposed to the 300,000 range?
Senator, we see when they come to us with our $300,000 loan limit, we see them scaling their plans and their ask to what they think they can get from us. If we had a higher loan limit, then they might reach further for the stars. And of course, everything's gotten more expensive over time. That's just the nature of money and time together. The time value of money, I think they taught us in business school. So our $300,000 loan limit has become somewhat obsolete, and $300,000 doesn't necessarily help launch many small businesses. We need to see more resources for that.
I saw, Ms. Guerrero, you were nodding your head. You would agree with the loan limit issue?
Definitely. I could have used $500,000 at the beginning of my business. And the reason why I say this is because I got that $300,000 from Common Capital, and about 2 years later, I needed an additional $100,000 from another lender. So if I would have had that money from the beginning, that would be much easier for me.
And if I may, Senator, excuse me for interrupting, as Marina said, as a business grows, if they outgrow us, at least in Western Massachusetts, there's not another resource. We need to have more resource so we can help the businesses as they grow, not just as they establish.
That certainly makes a lot of sense. Ms. Guerrero, you got your loan through the Community Advantage Program, which was created, frankly, not too long ago, and it was started as a pilot program. Could I ask, how much was your loan from the Community Advantage Program?
The Advantage program gave us $250,000,
Almost
and then
up
I
to the
had
max.
an additional $50,000 microloan.
So without the Community Advantage Program, that you would have had a hard time getting your business off the ground?
It would not happen, Senator, because I wasn't going to fall prey. I wasn't going to fall prey of predatory lending.
How are you doing now?
Oh, we are doing really well. We're really excited. I must say, we're in conversations with Boston Impact Initiatives, which is a venture capital sort of firm that works with minority owners. And they're going to do a structured equity deal with us and just give us money so that we can have double the workforce that we currently have. So we're about to grow significantly.
Congratulations.
Thank you.
I really wish you the best. Mr. Lanza-Weil, then, can you speak a little bit more about the importance of community lenders? Because community lenders in a state like Hawaii are very important, but that's where your experience lies. Can you talk a little bit more about how important these kinds of lenders are?
Absolutely. I think any high-touch lender is very important. I started my career at a community bank in the San Diego area. To the extent that the bankers on either side of me are community lenders who have a high-touch approach, I think that's very important. I think on the continuum of credit, we need everything from community lenders that are certified CDFIs and other community loan funds on through to community banks and credit unions. It's the know your borrower conversation that I think perhaps you weren't in the room for yet, Senator. The first rule of lending is know your borrower. Smaller banks, community banks, and community loan funds get to know their borrowers, and that enables them to say yes more often and to manage the risk when they do say yes.
So for the two witnesses who are sitting to the left and right of you, are you both community lenders?
Yes, I'm an SBA lender that works for First Security Bank, and we're a community bank.
So you certainly would agree that community lenders like yours, very important. You too?
Yes, Senator, we're a community bank in middle of Iowa.
Thank you. Thank you, Madam Chair.
Thank you very much. And I think we'll go ahead and wrap our hearing. Okay, I want to say thank you so much for the witnesses for being here today. This was a very productive conversation. Really appreciate your time and input to the committee today. And I ask unanimous consent that the record of today's hearing remain open for 2 weeks for members to submit questions, revise and extend their records, and submit additional information into the record. Without objection, so ordered. And with that, the Committee on Small Business and Entrepreneurship.
Can I make a closing statement?
Yeah. Oh.
Okay, please.
Ye-
Yeah.
yes, I
You'll like
suppo-
it. You'll
I
like it.
suppose so.
Okay, good.
We'll allow.
Okay,
Proceed.
thank you. Just want to say that the Community Advantage Program is a pilot program, not the law. And the Senate Small Business Committee, in its wisdom, in 2013, passed out of this committee by 18-1 the codification of the Community Advantage Program. It was blocked on the floor by Senator Paul, which is a common fate for many pieces of legislation, I might say. But we could work together once again to try to pass that bill. And I just wanted to note that even in early defaults, it was 1% during the Trump administration back in 2019, and it was 1% last year in the Biden administration. And it went down lower, actually, because of PPP and EIDL, but even the early default is kind of just returning to where it was before COVID. And the 7A loan program is healthy. 99% of loans are being repaid. Despite the short-term increases in the default rate, this rate is actually normalizing back to pre-pandemic levels, which is great. And I just want to go back to Mr. Wentworth at the First National Bank of Malden. I remember sitting there. He looked a lot like you. Well, Mr. Wentworth really didn't look like you, Mr. Weil, if you know what I mean. But the earlier generation, those old waspy bankers in New England, in that small city. My father drove a truck for the Hood Mill Company, and my mother was very mad at me for losing the full scholarship. You know, that I should have studied harder, she said. And we're sitting there, and my mother said, take out as much money as you want, Eddie, because you're going to pay it back, not your father. He's not going to take a second job. And I was in Congress at age 30, and because I went to the Loras College and Law School of Boston, called Boston College and Boston College Law School, I was elected at age 30. Those loans helped. My father was a milkman. And I was paying back the student loans for 6 years as a member of Congress. I was the poorest member of Congress. All I had was student debt and my car payments. I had no other assets. But he knew his lender. I mean, he knew his customer. He knew who he was loaning to. It was my mother and father, and they would make sure I paid it back. So essentially, that's the essence of who you are. You're giving people who maybe the rest of the world can't quite see as well as they could, but because you know them and you trust them, you make them work at the same level as other businesses that maybe have those pre-existing relationships. So I thank you so much, Madam Chair.
And witnesses, stay put. We had one member sneak in before the fall of the gavel. So Senator Hickenlooper, you are recognized for 5 minutes.
Thank you, Chair Ernst, and I appreciate you allowing the meeting to extend. I appreciate your indulgence. This is something I really care about, but in a previous life, it seems like several lives ago, I came in as a new governor in Colorado, and we did a bottom-up economic development plan. We went to all 64 counties, got everyone to write an economic development plan of what did they see in 50 years for their community, what should the state do to get there. And we took all those together, and we made something we called the bottom-up economic development plan. And it was amazing how universal the vision was. Some was obvious: cut red tape and needless bureaucracy. Sometimes it was get a better workforce training, stop marketing the state for skiers, but for entrepreneurs. But one thing we heard everywhere was to find ways to get better access to capital for people trying to start small businesses. So, Mr. Lanza-Weil, I guess I'll start with you. This Community Advantage Program of expanding access to capital for underserved communities. I mean, it supports so many entrepreneurs in a variety of small businesses, and helps them in accessing capital. In many cases, they wouldn't be able to find that capital anywhere. They're not from a community that has a lot of family money or friends and networks already in place. So how has the Community Advantage Program made it easier for Common Capital to reach some of these underserved communities?
Thank you, Senator. I recall you were in the brewery business, is that correct?
Well, it was a brew pub, so it was really a restaurant, but it had a brewery inside of it.
Three of our 41 Community Advantage borrowers have been microbreweries and
get
brew
out.
pubs.
Really?
It's a true fact.
Who knew?
Every single one of our 41 Community Advantage borrowers came to us with a weakness that we could not overcome through our standard underwriting. It's almost always a lack of collateral. We have people that have saved money for years to have their 10% equity injection. They've gotten the experience they need in their industry. They have a good business plan that's reasonable and achievable. They're buying assets, in some cases, with their loan. In the case of Mayrina, it was couches and clocks. In the case of a microbrewery, it's some hard assets that have more value. But every small business that forms, that starts up, needs working capital, and that doesn't act as collateral on its own. So we've needed the CA program to help bridge the gap when we've had a collateral deficiency. And I want to make clear, Senators, that that doesn't cover the whole thing. The guarantee is only 75 or 85%, or in one exceptional case, 90%. We're still taking risk in the formation of that business, as is the entrepreneur who's put everything they have into it. And if it weren't for the Community Advantage Program, we wouldn't be able to make many of those loans. Mayrina's expressed already that her business wouldn't exist without it.
Yeah, I appreciate that, and I salute you for all that work. I salute all of you, really. When I read the docket last night, it was really impressive. Mayrina, obviously the small businesses are important not just for the entrepreneurs, and not just for the employees, but for the communities they serve. In many cases, they serve a niche, and one of the wonderful things about small businesses in underserved communities, people live there. They know what the niche is. They know what the community needs, and I think that's an advantage that many businesses don't have. You've talked about how the SBA programs helped you start your business, Colorful Resilience. Love the title. We entrepreneurs spend our lives thinking of good titles, good names. But I love the notion of Colorful Resilience in terms of mental health. It's a very powerful image. Well, how would you describe the impact of your business on your community?
Well, huge, really, because the communities that we serve, the BIPOC, LGBT, first-generation immigrant communities, have just historically been underserved just forever. And that gap became greater after the pandemic. And so we all know that there's a mental health crisis. There's a lack of providers for the demand of mental health services. So our existence and that cultural competency that comes from working with providers that have shared identities has been huge. It's a huge impact in the community. For example, my marketing budget is $80. $50 for my website, $30 for my Psychology Today directory. Why? Because clients come to me, I don't go looking for them. So that tells you the impact that it has in the community.
Absolutely. Amazing.
Senator, may I add to that, please?
You have to talk to the chair because I'm out of time.
Madam? Mayrina's business is not the only culturally competent and focused mental health care business that we've financed. And we have, I think, a total of 5 mental health therapy businesses in our portfolio. But Mayrina's and one other are very much focused on people of color and others that have been traditionally underserved.
Yeah. It's a great example. I'm so glad you guys could find time to come here. And I will watch. I've been running around, but I will watch the videos tonight to catch up. Anyway, I yield back to the chair. Thank you.
Thank you, Senator Hickenlooper. Okay, we're going to try this again. Thank you very much to our witnesses. Thank you again for being here today. Really productive discussion. Thank you for making it in right before the fall of the gavel. So at this time, I will ask unanimous consent that record of today's hearing remain open for 2 weeks for members to submit questions, revise and extend their records, and submit additional information into the record. Without objection, so ordered. And with that, The Committee on Small Business and Entrepreneurship stands adjourned. Thank you all very much.